Hi there, welcome back to another episode. In today's program, we're going to talk about the top myths that we hear in the self-directed IRA industry. I have found over the last 15 years, there's a lot of misinformation, just wrong information, inaccurate content. I want to make sure that I dispel the top myths that we see on a continual basis so that you as an investor can make an informed decision. As always, here on this episode, we'll answer one of our viewers' questions at the very end. Make sure to drop your questions in the comments box and also hit the subscribe button and the little bell icon. That way, when we have upcoming videos, we can make sure that we alert you. Let's get started. So our first myth is that you need to start with a large amount of money in a retirement account in order to self-direct into alternative investments, also sometimes referred to as private market transactions. And that's so far from the truth. I've had the opportunity and privilege over the last 15 years to witness hundreds of investors grow a small amount of money in an IRA into a much more meaningful balance over many years. Now, this is through, of course, investing activities, self-directing their retirement accounts into unique private market transactions, and then also through annual IRA contributions. So let's talk about that first. How much can you contribute to an IRA on an annual basis? Well, in 2023, you can contribute up to $6,500 when you're under the age of 50, and this is providing that you're eligible to make a contribution. And then when you're 50 and over, you can contribute up to $7,500. There's a $1,000 catch-up provision there. And then let's fast forward to the turn of the year. So we're getting very close to the turn of the year. Before we know it, it'll be 2024, and you can make a 2024 contribution. Now, because of the cost of living adjustments, the annual IRA contribution is going up by $500. So if you're under the age of 50, you'll be able to contribute up to $7,000, and then if you're 50 and over, up to $8,000. So when you think about it, between now and the turn of the year, between your 2023 and your 2024 contribution, if you're under the age of 50, you can contribute $13,500. And then when you're 50 and over, between your 2023 and 2024 contribution, that's $15,500. Now, it doesn't stop there, because let's also consider a spouse. So if you have a spouse, even if they're not working, but you're working, or vice versa, that spouse, they can make their own contribution to their own individual IRA. Now, here's sort of another sub-myth here. A lot of people have the impression that if they have a spouse, or maybe they're the spouse that doesn't have any actual earned income, they're led to think that they can't contribute to an IRA. But what you'll learn is that as long as you're married filing jointly, and one of the two married spouses has earned income, then spouse A's earned income can support spouse B's contributions. This is known as a spousal IRA contribution. You can actually go to publication 590 through the IRS, go to irs.gov, search publication 590, and you can pull up this information and review it on your own time. And so this spousal IRA contribution can be very important, because that means you could potentially get double the contributions into IRAs on an annual basis between you and your spouse. Now, here's a secondary myth. Some people are led to think that they can have one individual IRA and make contributions for both spouses. You can't do that. You have to have two separate IRAs, and then each spouse makes their own individual contributions. From an inheritance perspective, of course, you can name yourself on your spouse's account as the death beneficiary, and then vice versa. So that way, in the event that one of you passes away, you'll have the peace of mind knowing that the other spouse will receive that account. And they can actually take the account as what's called a treat as own. So it'll become their IRA. In a separate video, we actually talk all about inherited IRAs and how that process works. Okay, so when you think about it, between a 2023 and 2024 contribution between you and your spouse, that's a total of, if you're under the age of 50, that's a total of $27,000. You can get into IRAs in a pretty short period of time here. And then if you're 50 and over, that would be $31,000. Now, totally separate from IRA contributions, you have 401k contributions. And 401k contributions for 2024 have gone up by $500 as well. When you're under the age of 50 for a 401k, you'll be able to contribute up to $23,000. And then there's a $7,500 catch-up for those that are of the age of 50 or older. And then, of course, you have the employer match or employer profit sharing plan side of that contribution. We have, in our last episode, we talked all about those business retirement plans. If you want to go back to that last video to learn a little bit more about that. A third sort of myth, sub-myth here is I can only contribute to my IRA or my 401k at work. And that's so far from the truth. You can contribute to both your 401k and your IRA on an annual basis. And then a fourth sub-myth here for you is some people are led to think that if they're contributing to their workplace plan, like a 401k, and if they make too much money, they can't contribute to a traditional IRA. So far from the truth. What they're referring to there is what's called a non-deductible IRA contribution. See, if you're contributing to a workplace plan like a 401k or your spouse is, and you're combined over a certain income amount, then you may not qualify to get a tax deduction for a traditional IRA contribution. It's referred to as a non-deductible IRA contribution. It doesn't mean you can't contribute, it just means you don't get a tax deduction for that contribution. Whereas if you were under the income limits or weren't contributing to a workplace 401k, you would receive a deduction for a traditional IRA contribution. So that's really important to understand. And lastly, really important to understand, and this goes back to one of our previous videos where we talked about backdoor Roth IRAs, some people are led to think that they don't qualify to make a contribution to a Roth IRA. But what you'll find is many Americans do qualify to contribute to a Roth IRA. They've just never been told about the backdoor Roth contribution. Now, it may not work for everyone, but important to understand that a backdoor Roth contribution is where if you make too much money and you can't contribute to a Roth IRA, you simply contribute to a traditional IRA first, and then you immediately convert over to a Roth IRA. All right, so in conclusion, that's how you can contribute to an IRA, and that's going to be a component or a variable of the growth of that account is your annual contributions. But then in terms of growth, of course, we have the investment activities, right? If you contribute monies to an IRA, but you're not actively investing, you're not going to be able to observe and take advantage of growth in a tax-deferred or tax-free capacity. Like I always say, compounding interest in the absence of taxation. It's incredibly powerful. So you as the investor with a self-directed IRA have the ability to select and make all of the choices on behalf of your IRA. So let me give you one quick example of a small dollar or smaller dollar IRA transaction. Two clients here at Equity Trust, I'm going to keep their names anonymous, Investor A and Investor B. And Investor A and Investor B were both in the real estate business, and they met each other at a real estate investor seminar or conference. And these two investors came together and they had unique situations, both of them, that really created a good partnership opportunity. Investor A had about $13,000 and some change in his Roth IRA. He had about 2 years of contributions in there at that time. Okay, so he was very similar to this period of time where he was opening an account towards the end of the year and he made his contribution for that year, and then at the turn of the year he made his second year contribution. And so he had about $13,000 and some change in this Roth IRA. And he had an opportunity to acquire a property, and he knew it would be a good opportunity to put in the necessary renovations and repairs, paying someone else, of course, to do all that work for him. And then from there, sell the property and make a profit. So it was a fix and flip type transaction. Now, Investor A only had about $13,000 and some change in his Roth IRA, but he needed about $106,000 for the purchase and rehab of this property. And so here comes along Investor B that he meets at a real estate investor seminar. And Investor B has capital, but needs to find a place to deploy that capital so he can make an attractive rate of return. So it was a good partnership opportunity there because Investor B was looking for opportunities. Investor A had an opportunity to bring to the table. So they acquired the property as a partnership, as tenants in common owners. And separate from this partnership, tenants in common ownership, they had a joint venture agreement. And per this joint venture agreement, this was about a 3 to 4 page document that spelled out all of the terms and conditions and then the split of the profits. And the way they structured the transaction, or the joint venture partnership, was that 50% of the net profits would go to investor A and 50% of the net profits would go to investor B. So in this particular transaction, investor A put $13,000 and some change into the $106,000 transaction. Investor B put in just over $90,000. So investor B put in a larger amount of the capital needed for the transaction. But they split the profits 50-50, the net profits 50-50. When it was all said and done, they made about $68,000 in profit. And $34,000 of that profit went back to investor A's Roth IRA tax-free, and then investor B received $34,000 in profit. So they were both happy. Investor A ended up growing his Roth IRA from about $13,000 and some change to over $47,000 tax-free. So this was an interesting small dollar transaction that allowed investor A to put his money to work for him and be able to grow tax-free profits in a very meaningful way. Again, I always like to say compounding interest in the absence of taxation. I have another client here by the name of Scott, and Scott is in the self-storage business. And Scott had an opportunity to make a loan, a $50,000 loan to a self-storage operator, and then he charged 12% of the annual net profit and 12% of the profits from the sale of the property. So that $50,000 private money loan on that particular self-storage building ended up making him just over $50,000 tax-free in his Roth IRA. So what you'll find is there's interesting ways to invest in real estate or private money loan transactions in order to grow an account in a very thoughtful way. Lastly, there's also, of course, opportunities investing in private direct companies or private equity, venture capital. So over the last 15 years, I've had the opportunity to witness and observe individuals invest in some of these opportunities and be able to create a meaningful profit through investing in the private markets. Now, keep in mind that there's risk associated with these opportunities. Sometimes there's a large upside or a very large reward, but what comes with that large reward could be illiquidity in the investment and, of course, risk associated with the investment. So always make sure that you're teaming up with your financial professionals and you're doing all of your due diligence on these types of private market transactions. Okay, so with that being said, let's now move on to number 2, which is moving funds from one retirement account to another will trigger taxes. So far from the truth. If you're following the process properly, transferring or rolling over funds from one retirement account custodian or administrator to an equity trust IRA will not trigger any taxes or penalties. Now, you got to make sure you follow the process the right way. You want to make sure that you initiate a trustee-to-trustee transfer or a direct rollover, or make sure if you do distribute funds from an IRA that you return those funds within 60 days. Now, this leads us to the third myth, which is a segue from the last one, and that is that you can only roll over money once a year. I can't tell you how many times I've had clients that come to me that went and talked to, maybe their current financial consultant and said, hey, I want to self-direct my money into private market transactions like real estate. Maybe they don't want to invest in the stock market or solely be invested in the stock market. So they want to move their money to equity trust as a custodian so that they can take control. And so they go to their current financial consultant that in some cases can only offer them public market investments. And they say, well, I want to move my money to equity trust. And sometimes these financial consultants will say, well, you can only do that once in a 12-month period. What they're actually referring to is what's called a 60-day distribution rollover. So if you distribute money from your IRA, take active receipt, as long as it's an IRA, not like an inherited IRA, you have 60 days to return that money to an IRA. If you return it within the 60-day window, then there's no taxes or penalties. But you can only do that once in a 12-month period across all of your IRAs, meaning you can't set up multiple IRAs and then do multiple 60-day rollovers on an annual basis. One 60-day rollover within a 12-month rolling period from across all of your IRAs. Now that is if you take a distribution and roll your money over. But if you do a direct rollover from like a 401k into an IRA, where the money never passes through you, it goes directly to your IRA, you can do that as many times as you want throughout the year. Or what if you have an existing IRA at another financial institution that doesn't allow you to self-direct, and you want to transfer that into an equity trust IRA? Well, you can transfer just a portion. You don't have to transfer all of it. And then if you want to move more money over at a later date, maybe you need extra cash for rehab of a property, or maybe you want to do a second transaction, you could always transfer more money over at a later date. So really important to understand the difference between a direct rollover, a trustee to trustee transfer, and that 60-day distribution rollover. That 60-day distribution rollover, that's a totally separate money movement. In fact, we have a separate video that talks all about that if you want to check that out. All right, our next question is, when investing in rental property, I lose depreciation. Well, this is another one of those myths that I hear routinely, and that is, well, why would I buy rental property with my self-directed IRA when I'm going to lose the depreciation? Well, what you have to consider is that with a self-directed IRA, particularly let's talk about a Roth IRA. If you buy a rental property with a Roth IRA, all right, that's after-tax money in the account, you buy a rental property, let's assume there's no debt financing on the property, you own it free and clear. Well, all of your rental income is tax-free. And then when you take that money out after 59.5, you pay no taxes. If you sell the property, there's no long-term capital gains tax. Long-term capital gains tax also exempt in the Roth IRA, so as long as you're following all of the other rules and guidelines. And so when you think about it, depreciation does what? Depreciation with rental properties that aren't owned in your IRA allow you to offset your income. So you have taxable income, and that depreciation lowers that taxable income, which of course is good when you're not using an IRA. But with an IRA, you're in a tax-exempt environment already. So you're actually not losing the depreciation, because keep in mind, there's no taxable income to offset. You want to look at the longer-term impact here. You want to run the numbers on the longer-term impact and look at the Roth IRA and the potential growth of that Roth IRA investing in rental properties. Now, a rental property might make more sense outside of your IRA. It might make more sense inside of your IRA. That's why you want to look at every single transaction on a case-by-case basis, and you want to make the determination on, is this good for my IRA or good for outside of my IRA? And a lot of real estate investors, you'll find they own properties inside and outside of their self-directed IRAs. I like to call this a rising tide. But be very, very careful, because you'll hear people that have some sort of biasy in the arrangement, by the way. You'll see some people out there will say, well, don't buy rental properties with your IRA because you lose the depreciation. Well, you're not losing depreciation. What you could potentially be gaining is the tax-free upside. All right, and then a segue from that myth is some transactions trigger unrelated business income tax. And so therefore, it does not make sense for me to use a self-directed IRA. So you'll see we have other video training all on unrelated business income tax. To give you the Reader's Digest version, if your IRA is investing in an ongoing trader business that's structured as a partnership and you have flow-through income, so it's not taxed as a corporation, but the income flows through, and if the nature of the business is an ongoing trader business, then your IRA can be subject to unrelated business income tax. So for example, let's say my IRA invested in a friend of mine's landscaping company. And let's say that landscaping company is structured as a limited liability company and all the income passes through that LLC and goes to my IRA. Well, that's going to be considered an ongoing trader business, and I'm going to have to address unrelated business income tax. Unrelated business income tax can also apply when my IRA is invested in a debt-financed real estate acquisition. And sometimes you'll hear this referred to as unrelated debt-financed income or unrelated debt-financed income tax. And this could also be if my IRA is invested in like a syndication or a partnership, maybe that owns an apartment building or other commercial real estate. And if there's debt on that property, the unrelated business income tax can flow through that partnership to my IRA. Now, there's some math involved with this and some accounting involved with this, and I, of course, would encourage you to team up with your CPA or other tax preparer to do an analysis of how this would look or how this would affect your circumstances. What's important to understand is if you're paying the unrelated business income tax, then you're making profit. And the profit less the tax that you paid is going into your IRA. And then that amount will continue to grow tax deferred or tax free. So the conclusion of this is don't be fearful of unrelated business income tax. Do your due diligence and determine if it makes sense. Some investors that I've worked with, they've run the numbers and they've come back and they said, well, if I do this transaction with my self-directed IRA, yes, I'm paying unrelated business income tax. But after I deduct that tax I pay every year, after I file my 990T and the associated tax documents associated with this, after that's all said and done, my profits are still better than what I would be making in other investments. So in other words, it makes sense for them financially long-term to still do that transaction despite the unrelated business income tax. Now, here at Equity Trust, we can't run those numbers for you. I can't tell you whether it's a good transaction or not a good transaction. We would encourage you to team up with your CPA or run the numbers on your own to determine what's going to make the most sense for you. All right, so that rounds out our 5 myths. Let's go ahead and jump into one of our questions. This is from Vess6613, and they say, for tax-free and penalty-free withdrawals prior to 59.5 age, does only the contribution amounts qualify, or both contribution and conversions included? So important to understand that with a Roth IRA, when you make a contribution, whatever amount you've contributed, you can actually take out at any time tax and penalty free. But the growth has to stay in there for 5 years, and you have to attain the age of 59.5 before you can take tax and penalty free withdrawals. Now, contributions are treated differently than conversions. They call these ordering rules. So publication 590, you can look up this further. They're called ordering rules. So if you convert money from a traditional to a Roth, maybe you want to pay the taxes on the seed so you don't have to pay in the crop. When you convert from the traditional to the Roth, that amount that you convert has to season on its own for 5 years. Now it is first in, first out. So if you have a Roth IRA that's already seasoned with, let's say, $100,000 and you're over 59.5, and then you convert another $100,000, at least you know that initial $100,000 you can take out anytime tax and penalty free, but that $100,000 that you just converted in is going to have to season for 5 years. Thank you so much for your question. Really appreciate it. Also appreciate your kind words in the comments about all of our video content. So I encourage everyone, feel free to insert your questions in the comments box. Make sure you hit the bell icon and the subscribe button. That way we can alert you to all of our upcoming videos. And last but not least, if you like the content around small dollar IRA investing, I talked about that real estate joint venture transaction. I talked about private money lending with maybe a smaller amount of money in a retirement account. What about partnering multiple accounts together? There's a lot of different ways in which you can consider growing a small amount of money in a fairly short period of time. We have a course that we've designed specifically for this topic called the Small Dollar Wealth Accelerator. So in the notes box below, you'll see a link, and my team will post a promotional discount there for you as well, so you can check that out. And what you'll learn in this course is the case studies, the information. We go through real client investment examples. There are sample documents that you can give to your attorney or your CPA so that you can devise a plan that's going to work for your specific situation and the types of transactions that you want to do. So I encourage you to check that out as well. And then, of course, as always, until the next episode, keep leveraging compounding interest in the absence of taxation. Thank you.